Thanks so much, everyone, and welcome back. You just heard from Robert Promisel giving us an overview of what he's seeing in listed property markets globally. I'm very pleased to welcome our next and final speaker for this morning, Steven Romick, founder at FPA and portfolio manager of the Nedgroup Investments Global Flexible Fund. Steve, warm welcome. Nice to have you here. Always lovely chatting. How are you doing?
I'm doing very well, thank you. And you? You good?
Yeah, great. Thanks. It's always nice to chat to the fund managers on this quarterly feedback webinar, and the clients love it. So it's good that we always provide great content. So shall we jump into
Thank
it?
you for joining me today for our mid-year Global Flex update. We appreciate it on our side here in Los Angeles.
Brilliant. So Steve, I guess just to kick off then, just to cover a bit of performance, I mean, how do you feel the fund has performed relative to the performance indicator, please?
Well, the fund, declined 1.2% in the first quarter, but gained 5.6% in the trailing 12 months, approximately in line with the fund's performance indicator, but behind both the MSCI indices. More importantly, by focusing on more extended time periods as we do, the fund is ahead of its performance indicator for all periods greater than 1 year.
And maybe if you can please perhaps highlight some of the investments that have proven to be meaningful to the fund's trailing 12-month returns, please.
Sure. It's interesting in the slide that you have in front of you, as you that you can review in the trailing 12 months. There wasn't any significant news that drove the winners higher and the losers lower. I mean, Global Flex's top five performers, while it contributed 3.2% to its return, Jefferies and Holcim, Meta, Kinder Morgan, and Wells Fargo, there just wasn't any piece of news that was really just a driver of its return. And the same is true of the bottom five that attracted, 1.7%, in Comcast, Glencore, Icon, Ferguson, LG Corp. I mean, it's interesting because when we buy companies, we're always looking for bad news or some relative level of misunderstanding or appreciation for what the longer term prospects of a business is. And in these stocks will, for the long periods of time, we often end up holding them, will go up and down. And as long as the story remains intact and they don't become too expensive, the growth is there, we'll retain those positions. And a good example that would be Glencore, which is in the bottom five, and people are fearful of what the commodity pricing. Glencore is one of the larger commodity complexes in the world, owning mines and trading operations and such. And that business, interestingly, is has been, stock's been down dramatically, but the former CEO just stepped up and bought 1% additional shares, even no longer being involved in the company just a couple of weeks ago, taking his share ownership up to 10%. So clearly, he sees the value just as we do.
Thanks, Steve. And I mean, talking about seeing value, would you say there's too much confidence in the market at the moment?
I mean, good performance clearly tends to breed complacency. 2024 ended on an optimistic note. I mean, and the slide that you have in front of you reflects that the most significant proportion of investors since 2008, 2009's great financial crisis believe there was more than a 10% probability of a stock market crash. So 43% of investors didn't think there's a chance that the market was really going to go down significantly. Now, as you can see from the chart, when COVID-19 hit in early 2020, just 13% of the people, of investors, thought a significant market decline was likely. Ironically and illogically, investors believe a crash is less likely when stocks are up, but when it's down, they think it's more likely. Now, with the recent market turmoil, that level of confidence has dropped to 34%, but that's still above average. I mean, there's still a sense of, this will all the problems that are out there in the world will be resolved satisfactorily to the market's benefit.
And are there pockets of overvaluation that you're seeing at the moment?
Yeah, I mean, companies are even with the recent market declines, many companies are still trading at indefensible prices. Beyond the magnificent seven stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, numerous other more mundane but good businesses have tapped into this investor zeitgeist, and in our opinion, have achieved, cult-like status. Now, this admittedly curated list of companies that you have in this slide in front of you um, is, sells things like paint and uniform, mops, air conditioning, and heating equipment. And one of them stores old paper documents. They've all seen their stocks soar. And at the end of the year, they traded, about, 40 times 1 year forward earnings, which is nuts for the level of growth they've been able to exhibit. Their average PE is nearly 3 times the estimate of the next 3 year projected earnings growth. Now, we find it difficult to accept that these companies, most of them we think are very good companies, trade at such high multiples, especially when we believe Crescent's equity positions offer a better value, trading at a lower PE. I mean, 15 and a half times forward earnings versus the 40 times, with similar projected earnings growth.
And Steve, you mentioned very briefly about the Mag 7. Would you say the market's still being driven by a handful of stocks, or is something changing there?
Well, only a small percentage of stocks, around 30% in the S&P 500, outperformed the index in 2023 and 24, as exhibited on the right-hand side of this chart. The last time we witnessed such narrowness was an internet bubble at the turn of the century.
Wow, yeah, sounds crazy. And I guess just with, Trumps and tariffs, look, I have to ask you about this, given everything that's going on globally. Can you please share some of your views?
Well, I've been calling it Disneyomics. We've seen the movie. Disney is the Lion King, particularly if you have kids. And we may as well be living in Pride Lands shortly after Mufasa's death. Scar treacherously usurps the throne and then rules for his benefit without regard to the greater good, fomenting chaos and upending the social order in the process. Scar mismanages Pride Lands and he ultimately betrays the supporters, the hyenas, and he's exposed for lying, failing to deliver on his promises, and then blaming others, and the disenfranchised hyenas again. So in this story, Scar is Trump or Trump is Scar, and it all remains to be seen what happens. It's clear that investors always are fearful of uncertainty, but nothing is ever certain. In strong economic environments and stock markets, complacency rather, creates false confidence. But it's impossible not to be concerned with what's happening today.
Mm-hmm. And just, over the last year or so, how would you say the portfolio has changed to kind of take into account all these views?
Now, while we didn't anticipate the uncertainty of the company, the tariffs, and we still don't know what's going to happen, markets, as I pointed out in a couple slides prior, over a few slides, are fairly expensive. There's a tremendous amount of confidence. Valuations are high. And unlike the crowd, we tend to lean into stock market weakness and sell into strength. So with stocks up in the recent couple of years, it should be no surprise that Global Flex's net exposure, equity and bonds, declined nearly 7 percentage points year over year to 57.5% at the end of the first quarter. Now, while the lower exposure is really more a function of less opportunity that's out there, we haven't sat idle. We've added 3 new equity positions to the portfolio and decreased 1 other.
Thanks, Steve. And tell me, is there a particular region or sector that stands out in your positioning, please?
We make available for everybody what our asset exposure is by sector, and that's displayed on this chart. Cash remains the most significant allocation, and as equity investments have gone down and debt investments slightly, our cash has gone up, and cash is now at 42.5%. But the most prominent risk exposure continues to be the broad sector of communication services at 12.2%, but we've been finding some more opportunities of late in healthcare.
And Steve, I guess just the last thing I wanted to just tap your brain on before you go is, how should an investor look at the geographic composition of the fund, please?
Approximately 40% of Global Flex's equity exposure is to companies outside of the United States. Now, as we often point out, where a company is based is of secondary importance to the quality of a business and the price at which it trades. More relevantly, if we examine the revenue composition of our portfolio companies, you can see in this table, we will see that they derive more than half of their sales from outside the United States. And we are fortunate to be able to invest broadly as other parts of the globe trade less expensively than the United States.
Steve, that's brilliant. Thank you so much for your time. It was very insightful. It's always lovely having you on the call.
Thank you.
And to our audience, thank you so much for joining us this morning. I hope you found this absolutely worthwhile of your time. Have a great day, and we look forward to seeing you at one of our next events in the near future. Thanks so much. Have a good day.